Picture this scenario. It's a rainy Sunday afternoon. You're up in the attic, finally getting around to clearing out those dusty boxes that have been sitting there since, I don't know, since you moved in. You're sifting through old college textbooks, broken kitchen appliances, maybe some questionable fashion choices from the 90s.
The archaeology of your own life.
Exactly. And then you spot it. A long white cardboard box tucked away in the corner. You open it up, and inside, preserved in a plastic sleeve, is a comic book. Let's say it's Amazing Fantasy #15.
Ooh, the Holy Grail.
The Holy Grail. The first appearance of Spider-Man. You remember buying this, or maybe your grandfather bought it, for, 12 cents at a newsstand? You pull out your phone, your hands are shaking a little bit, and you check the market price.
And your jaw hits the floor.
It hits the floor.
Yeah.
It is worth a fortune. We are talking a life-changing amount of money. It's like a winning lottery ticket that's been sitting under a pile of old winter coats for 40 years.
That is the dream, isn't it? The unexpected windfall, the hidden treasure.
It is the absolute dream. So you go through the whole process, you find a reputable auction house, you get it graded, the marketing ramps up, and finally the gavel bangs. You sell it, you're ready to collect your millions and, I don't know, sail off into the sunset.
But then
the realization hits you. That profit, it isn't entirely yours.
No, it is not.
There is a silent partner in the room. A partner who took zero risk, who didn't preserve the comic, who didn't buy it at the newsstand, but who is standing there with their hand out waiting for their cut. And depending on where you live on this planet, that cut could be massive.
And that silent partner, of course, is the government.
Today, we are diving deep into the world of capital gains tax, or CGT for short. Now, I know what you're thinking.
Yeah.
Taxes. Really, I'm going to tune out. But let me stop you right there.
Please do. Because this isn't really about filling out forms or, crunching boring percentages.
It's not. This is about a mechanism that fundamentally changes how human beings behave. It changes when we sell our houses, how we invest in the stock market, and even whether we decide to, cheat the system and become criminals.
It creates market distortions. It locks trillions of dollars in place, freezing them in the economy. And as we will see, it is handled wildly differently depending on where you stick a pin in the map.
So our mission for this deep dive is to move beyond the boring definitions. We want to figure out why selling a house or a stock is so complicated. We have a massive stack of research here. We're talking historical data from Japan, policy shifts in Kenya, and some heavy-hitting economic studies on tax evasion. Let's unpack this.
Let's get into it.
First things first, we need to lay the groundwork. We need a working definition so we're all on the same page. What exactly is a capital gains tax?
Well, based on the source material we have, the definition is actually quite specific, and every single word matters. A capital gains tax is a tax on the profits realized on the sale of a non-inventory asset.
Okay, there are two really heavy concepts in that sentence. Realized and non-inventory. Let's start with non-inventory. What does that even mean?
So this is the distinction between a business running its daily operations and an investment. If you run a shoe store and you sell the pair of sneakers to a customer, that is your inventory.
Right, the stuff you sell.
The stuff you sell, that is regular business income. You buy shoes, you sell shoes, that's your job. The profit you make there is taxed as income.
Okay, that makes sense.
But if you as an individual buy a stock or a bond or a piece of precious metal or a rental property and you hold on to it, that is a capital asset. You aren't in the business of selling that specific item every day.
It's an investment, not a job.
Exactly. So when you eventually do sell it for more than you bought it for, that profit isn't income in the traditional sense. It is a capital gain.
So the government effectively treats the money I make from working my labor differently than the money I make from waiting. From my money-making money.
Essentially, yes. And that brings us to the second word, which is arguably the most important word in this entire deep dive. Realized.
Realized.
Yeah.
This is the idea that paper wealth isn't real wealth, at least not to the tax man.
Correct. Let's go back to your Spider-Man comic book. Let's say you found it 10 years ago. You checked the price then, and it was worth, $500,000.
Okay.
Today, you check it again, and it's worth $1 million. On paper, you made $500,000 while it sat in the box. Your net worth went up. You are, for all intents and purposes, richer.
Right.
But the tax man doesn't come knocking. Not
But
yet.
because I haven't sold it. I don't have the cash in my pocket. It's still just a comic book.
Exactly. You haven't realized the gain. The tax event is only triggered when the transaction happens, when you exchange the asset for money.
Which seems logical, right? I mean, I can't tear off a corner of the comic book and mail it to the IRS to pay the bill. I need the liquidity from the sale to pay the tax.
It is logical, and it solves a very real liquidity problem for taxpayers. But, and this is a huge but we're going to get into, that simple rule taxation upon realization creates a massive psychological loophole.
A loophole?
It creates what economists call the locked-in effect. It essentially gives you a massive financial incentive to never, ever sell.
We're definitely going to deep dive into that locked-in concept because it sounds like a trap. But sticking to the mechanics for just a second, is every single dollar of profit taxed? Like, if I sell an old bicycle at a garage sale for $50, am I committing tax fraud if I don't report it?
Generally, no. I mean, the government isn't interested in your garage sale or your used toaster.
Good to know.
They usually set thresholds or boundaries. They're looking for the big fish, generally speaking.
Right.
If your profit is below a certain limit, it might be tax-free. And the calculation is usually straightforward, at least on paper.
On paper.
It's the sold price minus the purchase price. And that purchase price, the official term, is the cost basis. The difference is your profit, your capital gain.
Cost basis. So that's just fancy accounting talk for what I paid for it.
Usually, yes. Although, as we will find out in the avoidance section later, that cost basis can, well, it can change in some pretty magical ways if you inherit property or use certain loopholes. It's not always a fixed number.
Ooh, I love a good loophole. Now, another thing I noticed in the research is that individuals and corporations don't always play by the same rules.
That is right. Most countries have different rates for individuals versus corporations. Corporations often treat capital gains more like regular business income because, well, they are businesses. Buying and selling assets is part of their operation.
Yeah.
But individuals often get preferential rates. The thinking is that governments generally want to encourage individuals to invest, to save for retirement, to buy homes. So they often tax capital gains at a lower rate than your salary. It's an incentive.
And what happens if I'm, a terrible investor? What if I lose money? Let's say I sell that comic book for a huge profit, but I also sold some stocks that absolutely tanked. Do I still pay full tax on the comic book?
Usually, no. This is the concept of the offset. It's the one mercy the system offers, really.
The consolation prize for bad investing.
Exactly. Most systems allow you to take your capital losses and subtract them from your capital gains. So if you made $10,000 on the comic, but lost $10,000 on the stock, your net capital gain is zero. You pay nothing.
And if I lost more than I gained?
Then you usually have a net capital loss. And in many places, you can carry that loss forward to future years to offset future gains. It's the government effectively sharing in your risk, but only to the extent that it lowers your tax bill on other winners.
Okay, so that's the machinery. You buy low, sell high, and pay a percentage of the difference when you sell after accounting for your losses. But you mentioned earlier that this tax changes human behavior.
This is where it gets really interesting. This is the behavioral economics of capital gains tax.
And this brings us back to that locked-in effect you mentioned. Break that down for us. Why does realization make me freeze?
So imagine you own a stock. You bought it for, let's say, $10, and now it is trading at $100. You have a massive $90 gain per share.
I'm feeling good. I want to sell and go buy a boat.
But wait. The moment you click sell, you trigger a tax event. If you sell now, you have to cut a check to the government for, let's say, 20% of that $90 profit. That's $18 per share. That is immediate pain. The money is gone.
Right.
However, if you don't sell, what happens? You keep that money working for you. The tax liability is there. It's hovering over you, but you don't have to pay it yet.
So I get to keep investing the full $100, not just the $82 I'd have left after tax.
Precisely. You are effectively getting an interest-free loan from the government equal to the amount of tax you would have paid. You get to keep earning returns on the government's money.
Oh, I see. By postponing the tax, I am keeping more capital in the market to grow. It's a deferral strategy.
It's a powerful deferral strategy. And even if the tax rate goes up later, the present discounted value of that tax is reduced by waiting. It creates a very strong incentive to hold on to assets way longer than you naturally would. You become locked in.
So I might have a stock that I think has peaked. My brain is telling me I should sell it, but I don't because I hate the idea of paying that tax bill today.
Precisely.
Yeah.
You are making an investment decision based on tax policy, not on the fundamental quality of the asset. And that's a huge market distortion.
Is there evidence that this actually happens on a large scale? Or is this just economists theorizing in a classroom?
Oh, it's a huge debate with a lot of data behind it. The source material points to Martin Feldstein. He was a big deal, the chair of the Council of Economic Advisors under President Reagan. He was a massive proponent of this theory.
What was his specific argument?
He claimed the effect was so massive that if the government reduced the capital gains tax rate, they would actually make more money in tax revenue.
Wait, lower the tax to make more money? That sounds completely counterintuitive.
His logic was that the lower rate would unlock the floodgates. All these investors sitting on decades of unrealized gains would finally say, okay, the penalty for selling is low enough now, I'll cash out.
So the sheer volume of new sales would be so high that it would more than make up for the lower rate on each sale.
That was the theory, a gusher of revenue from all this pent-up, locked-in capital being released.
And did it work out that way? Is that what the evidence shows?
Well, it's complicated. The sources we have cite 1994 estimates that suggest a permanent reduction in the tax rate would actually have very little effect on revenue in that way. Maybe a short-term bump, but not a long-term one.
So the theory is a bit controversial.
It's very contentious. So while the locked-in effect is real, people absolutely do hesitate to sell because of tax years. The idea that cutting taxes magically pays for itself is still very much up for debate.
It seems like capital gains tax acts as a kind of friction. It's like sand in the gears of the market.
It is a transaction cost, a big one. And there is a fascinating study cited in our notes by Levy from 2006 that looks at this very friction.
This was the one about great versus small gains, right?
Yes. Jin found exactly what you would expect for large gains. Great capital gains, big profits. Strongly discourage selling. If you are sitting on a mountain of profit, you don't move. You are locked in.
Which confirms the Feldstein theory, at least in principle.
It does, but there was a twist.
What was the twist?
The study found that small capital gains actually stimulate trade. Investors are more likely to sell if they have a small win.
That's weird. Why would that be?
It's likely psychology. A small win feels like free money, The tax bill is negligible, so it doesn't trigger the same fear. It validates the investor's ego. Hey, I made a profit, without the paralysis of a massive tax bill.
So it's a confidence booster.
It could be. But once that number gets big, the tax paralysis sets in. The pain of the tax bill starts to outweigh the joy of the profit.
That is fascinating. So to be willing to sell a big winner, I have to really, truly believe the price is going to tank.
Exactly. You have to believe the asset price will drop by more than the tax percentage for it to make mathematical sense to sell. Otherwise, the tax barrier keeps you holding on, even if you're nervous.
Or I suppose you play the timing game.
The timing game? What do you mean?
Yeah, waiting for a new president or prime minister to get elected.
Political speculation. Yes, that is a huge part of the behavior. If you think a new administration will come in and lower the capital gains rate from, say, 20% to 15%, you just sit on your hands. You wait.
Which means money isn't moving.
It causes capital to freeze up across the economy. People with massive gains are just waiting for a legislative change. It's wild to think that factories aren't being built or businesses aren't being bought just because investors are waiting for an election result to save a few percentage points.
That is the reality of the tax code, though. It shapes the flow of capital in very direct ways.
It absolutely does.
Now, speaking of the tax code, we have to talk about the sheer annoyance of it all. We have a section here on the cost of doing business, and it's not just the tax itself, it's the cost of figuring out what you owe. The headache.
Right. And economists divide this into two buckets: administrative costs and compliance costs.
Okay, so administrative costs. That's what the government spends, right? The cost of collecting the tax.
Correct. The government has to hire auditors, build computer systems, process the forms, chase down cheats. We have data from a Canadian researcher, Francois Vaillancourt, from way back in 1989.
1989, a classic vintage. What did he find?
He looked at income and payroll taxes and found that the administrative costs were roughly 1% of the gross revenues collected. So for every $100 the government collects, they spend about $1 to run the system.
That seems surprisingly efficient. I would have guessed it was way higher.
It is pretty efficient on the government side, but the real burden, the hidden cost, isn't on the government. It's on you, the taxpayer, and that is the compliance cost.
The headache factor. The hours spent digging through old emails for a stock confirmation from 2004.
The headache factor, exactly. There was a great study from Minnesota in 1992 that tried to quantify this headache. They looked at households with capital gains versus those without.
And what was the damage? How much time are we talking?
Taxpayers with capital gains spent, on average, 7.9 hours more on their taxes than people without them.
Wow. Nearly a full workday. Just gone. Just trying to figure out the basis, the dates, the rates.
And that's not all. They also spend about $21 more on professional help. And remember, this is in 1992 dollars, so you have to adjust for inflation.
So it's real money, too.
The total extra compliance cost per taxpayer was estimated at $143. Again, 1992 dollars. That's money that just vanished. It didn't go to the government. It didn't stay in your pocket. It was just lost to the ether of paperwork and complexity.
And that's a cost to the economy.
It is. When we debate the efficiency of a tax, we often forget these hidden costs. If a tax raises $1,000 but costs the economy $200 in lost time and accountant fees to calculate, is it a good tax? The valid question.
And I bet people would work a lot harder than 7.9 hours to avoid paying the tax altogether.
Oh, absolutely. Which leads us perfectly into the gray areas, the world of avoidance, deference, and outright evasion.
I always get these mixed up. Avoidance is the legal stuff. Evasion is illegal.
Correct. Avoidance is smart tax planning. Evasion is a crime that can land you in jail. Let's start with the loophole tour, the legal ways people dodge or delay capital gains tax.
Okay, I'm taking notes. What's the first stop on our tour?
The family transfer. In the U.S. specifically, tax brackets matter a great deal. If you're a high earner, you pay a higher rate. But maybe your college-age kid or a retired parent has very little income.
Right, they're in a low tax bracket.
Or even the 0% bracket. So if you transfer the asset to them, you gift it to them, and they sell it, they might pay a much lower rate, or even no tax at all.
So the profit stays in the family, but the government's cut shrinks or disappears entirely.
Precisely. Then there's the charity angle. This is a big one. If you have a highly appreciated stock, you could sell it, pay the tax, and donate the cash. Or you could donate the stock itself directly to the charity.
What's the difference?
If you donate the stock, you often get to deduct the full market value from your taxes, and the charity, being tax exempt, can sell it and pay zero capital gains tax.
That's a win-win, I suppose. The charity gets more money, you get a bigger deduction, and the government gets nothing.
It's a very popular strategy. Then you have something called installment sales. This is where you sell an asset, but you agree to get paid over several years, not all at once.
How does that help with tax?
It spreads the capital gain out over multiple tax years. This can keep you in a lower tax bracket each year, and of course, it defers the tax bill. You pay as you get paid.
But there has to be a risk there, right?
A huge risk. If the buyer goes bust in year 3, you might never see the rest of your money. You are effectively becoming the lender in the deal.
Okay, what about the grim one? I see it in the notes here. Death and taxes.
Ah, yes, the ultimate loophole. In the U.S., this is known as the step-up in basis.
Okay, explain that. How does that work?
Remember cost basis, what you paid for the asset. Let's say your grandfather bought Apple stock in 1980 for $10. Today, it's worth, say, $200. If he sells it, he pays tax on a $190 gain.
Right. Makes sense.
But if he passes away and you as his heir inherit the stock, the cost basis steps up to the market value at the time of his death. So for you, the new cost basis is now $200.
So if I turn around and sell it immediately for $200...
Your profit is zero. Your capital gain is zero. The tax on 40-plus years of growth just vanishes.
Wow. That effectively wipes out the tax liability completely. It's like it never happened.
It does. It is one of the biggest drivers of intergenerational wealth transfer and, as you can imagine, a huge point of contention in tax policy debates.
I can see why. There are a couple of other U.S.-specific ones here, too. The 1031 exchange, what's that?
That is for real estate, specifically business or investment property. If you sell an apartment building, for instance, and you use the money to buy a like-kind property, like another apartment building or an office block, you could defer the tax.
So you can just keep swapping properties forever.
You can basically keep rolling the gains over and over from property to property and never pay the tax until you finally cash out and don't buy a replacement.
And opportunity zones. That sounds newer.
It is a newer program. The idea is if you take your capital gains from selling, say, a stock, and you reinvest that money into specifically designated low-income areas, you can defer the tax. And if you hold that new investment long enough, you can potentially eliminate taxes on the new investment's growth.
So it's a way to recycle frozen capital into struggling economies.
That's the goal, yes.
Okay, those are the legal ways to play the game. But what about when people just decide not to pay? What about evasion?
Evasion, this is where the data gets really shocking.
We have a study here by James Putterba from 1987. What did he find about the relationship between tax rates and Well, cheating.
He found a direct inverse correlation. A 1% decrease in the tax rate increased the reported tax base by 0.4%.
Meaning, if you lower the tax, people lie less.
Exactly. When the rate is high, the incentive to cheat is high. The risk seems worth it. When the rate is low, people figure, it's not worth the stress, I'll just pay it and sleep soundly.
But the real bombshell here seems to be the RJR Nabisco study.
Yes, this was an incredible piece of research. It looked at the shareholder data from the massive 1989 leveraged buyout of RJR Nabisco. It was a rare opportunity for researchers because they could see the actual transaction data and compare it to what people reported on their tax returns.
A perfect natural experiment. And what was the number? How much were they hiding?
They found that the average level of evasion was 11% of total capital gains.
11%. That's more than 1 in every $10 of profit just being hidden from the government.
Yes, just vanished into the shadows. And they confirmed the POTRBA findings as well. They found that a 1 percentage point increase in the marginal tax rate led to a 0.42% increase in evasion.
So the higher the tax, the more people cheat. It's a predictable human behavior.
It is. And that is a staggering amount of money leaving the system.
Yeah.
It really highlights the balancing act governments have to play. Raise the rate too high to get more revenue, and you might just drive everyone underground.
Or into different countries, which I think brings us to our global tour.
Yes. Let's fire up the jet. We're going to take a look at how the rest of the world handles this puzzle. And it is not a one-size-fits-all situation. Not by a long shot.
It seems like we can group these countries by their general philosophy.
I think so. Let's start with the most popular philosophy, the no-tax havens.
My kind of places. Where are we landing first?
Well, you have your classic Caribbean spots that everyone knows. Barbados, Belize, the Cayman Islands, Jamaica, also Bahrain in the Middle East, Isle of Man. In these places, generally speaking, there is no capital gains tax. What you make is what you keep.
But there are some major economies on this list, too. I'm seeing New Zealand and Singapore here. How do they manage that?
Yes, and this is where it gets nuanced. New Zealand, Singapore, and Hong Kong generally do not have a separate tax called a capital gains tax.
So if I sell a house in Auckland or shares on the Singapore exchange, I keep everything.
Generally. But there is a massive catch. If you are deemed to be a professional trader, or if you are trading frequently with the intention of making a living, they don't see it as a capital gain.
They see it as
business income. And your regular income tax rates apply, which can be quite high.
So the line between investor and trader becomes really, really important.
Crucially important. It creates a gray area. Let's look at Switzerland. For private individuals, there's generally no CGT on securities. It's a huge draw. But
the
local tax authorities have to decide if you cross the line into being a professional trader.
That sounds incredibly subjective. Do they just vibe check your portfolio?
They try not to. To avoid that, they have what they call safe harbor rules. Basically a checklist. To be safe from being labeled a pro, you must hold your securities for at least 6 months.
Okay, no day trading.
No day trading. You also have to have a low trading volume. Your total transactions can't be more than 500% of your starting capital in a year. And you can't be using a lot of debt or foreign capital to finance your trades.
So if you trade too much or too fast or with borrowed money, you lose your tax-free status.
Exactly. The system is designed to reward long-term passive investors, not active traders.
Okay, let's leave the sunny, tax-free havens and fly to the other end of the spectrum, the high-tax regions. I'm guessing we are heading to Europe.
Straight to Scandinavia. Denmark is often cited as having some of the highest rates in the world. They have a progressive system for income from shares. It starts at 27% on the first bracket of gains.
Which is already pretty high.
It is. But for gains above that threshold, it jumps to a whopping 42%.
42%. That is nearly half your profit just gone. Wow.
Finland is also up there, in the 30 to 34% range. And France has an interesting recent history. It used to be very complex. But President Macron introduced something called the PFU, or Prélèvement forfaitaire unique.
My French is rusty. What does that translate to?
It's basically a single flat rate levy, a flat tax. It's 30%. Before that, it was a complicated sliding scale based on how long you held the asset, which created a lot of confusion. The idea was to simplify the system and make France more attractive to investors.
30% flat. Simple, I'll give them that, but it's still a significant chunk. Now, we have to talk about the United States. It seems to be in a league of its own regarding how it treats its citizens, even when they're not in the U.S.
The U.S. is unique, and frankly quite notorious among its expats, because it taxes worldwide income.
Meaning what, exactly?
Meaning, if you are a U.S. citizen living in Switzerland selling a stock on the London Stock Exchange, Uncle Sam still wants his cut. Almost no other country on earth does that. If you're a citizen, you owe them tax, no matter where you live or where you make the money.
That's intense. And the U.S. system splits the tax by time, right?
Yes, this is a key feature. Short-term gains on assets held for less than a year are taxed as ordinary income. That could be as high as 37%, depending on your income.
Ouch.
But long-term gains for assets held more than a year get preferential rates. It can be 0%, 15%, or 20%, again, depending on your total income.
So the U.S. system is explicitly designed to discourage short-term speculation and encourage holding for at least a year and a day.
Precisely. It's another way of trying to separate the investor from the trader.
Let's hit a few more of these unique systems from around the world. What's going on down in Australia?
In Australia, CGT isn't a separate tax, which is interesting. It's just part of your income tax. You calculate your gain, and you add it to your other income for the year. But if you hold an asset for more than 12 months, you get a 50% discount.
So you only have to include half the profit on your tax return.
Right. It's a much simpler way of achieving the same goal as the U.S. system rewarding long-term holding without having a whole separate schedule of rates.
And Japan. You mentioned a weird history there in the outline.
This is fascinating. For a period from 1989 to 2003, Japan had an optional withholding tax system. You could choose to either calculate your actual gain and pay tax on that, or you could just pay 1.05% on the total proceeds of the sale.
Wait, 1% of the total sale price, even if I lost money on the deal?
Yes. It was an administrative convenience. If you didn't want to bother with the paperwork of finding your cost basis, you could just tell the government, here's 1% of the sale value and we'll call it even.
That sounds like an absolutely terrible deal if you're selling at a loss or a small gain.
It was, but it was optional. People with big gains and no paperwork might have taken it. Now, thankfully, they have moved to a more standard flat 20% tax on actual gains.
That makes more sense. Now, one issue that keeps popping up in my reading, and you see it debated everywhere, is inflation.
Ah, yes. The problem of the fictional gain. This is a huge philosophical criticism of the tax.
Right. So let's walk through the math here, slowly. Suppose I buy a stock for $100. 10 years go by. Over those 10 years, general inflation has doubled the price of everything in the economy. A loaf of bread that was $2 is now $4.
Okay, standard inflation.
My stock has also kept pace with inflation, and it is now worth $200. So I sell it for $200. On paper, I have a $100 capital gain.
Correct. The tax authority sees a $100 profit.
But in reality, that $200 buys me exactly the same amount of bread as my original $100 did 10 years ago. I haven't actually increased my real purchasing power at all.
Your wealth hasn't increased in real terms. You've only broken even against inflation.
But the government comes along and taxes me on that $100 gain.
They do. And this is the core of the critique. Critics argue it is a tax on inflation, not on real profit. You're being penalized simply because the currency lost value over time.
Do any countries try to fix this? Do they adjust for inflation?
Some used to. Ireland, for example, used to have something called indexation relief, where you could adjust your purchase price upwards by the rate of inflation. But they abolished it in 2003. Now you pay a 33% tax even if your entire gain was purely inflationary.
Ouch. What about Canada?
Canada has an interesting approach. They handle it by only making 50% of the gain taxable. The argument, though not explicit, is that by leaving the other 50% tax-free, they are roughly compensating for inflation and encouraging investment.
It's a kind of rough justice, but I guess it's better than nothing.
It is. It acknowledges the problem, even if it doesn't solve it with precision.
Okay, let's zoom in on one specific asset class that everyone listening probably cares about more than any other. Real estate. Their homes.
The roof over your head. This is where CGT becomes a massive political hot potato.
In most places, selling your own home, your main residence, is tax-free, right?
Generally, yes. It is known as the primary residence exemption, or principal private residence relief. You see it in Australia, Canada, France, the UK. The logic is that governments don't want to penalize people for moving house. It would impede labor mobility.
Right. If I have to pay a huge tax to sell my house to move for a new job, I might just not take the job.
Exactly. It would grind the economy to a halt. But there are always restrictions. In Australia, for instance, the property can't have been used to produce income, like running a business out of it or renting out a room. If you do, you lose part of the exemption.
And what about the flipping trap? People who buy a house, throw on a coat of white paint, and sell it 6 months later for a profit.
Oh, governments generally hate that. They see it as pure speculation that drives up housing prices for everyone else. So they create traps to catch these people. New Zealand has a great example called the Bright Line Test.
The Bright Line test? What is that?
It's a time-based rule. Initially, if you sold a residential property that wasn't your main home within 2 years, you paid tax on the profit. But as the housing market got hotter, they extended it to 5 years, and now it's 10 years.
10 years. Wow. So in New Zealand, if you sell an investment property within 10 years of buying it, you are treated like a professional property trader.
That's right. You pay tax on the profits at your full marginal income rate. It is designed specifically to stop short-term speculation and encourage long-term landlords.
And I saw a note about Kenya here too, which is an interesting case.
Yes, Kenya actually abolished its capital gains tax way back in 1985, hoping it would stimulate the real estate and stock markets. But they brought it back in 2015, a 5% tax, specifically on land and property transactions.
Why bring it back after all that time?
To try to control the spiraling cost of land, especially around Nairobi, and for the government to get a slice of the revenue from a booming real estate market. It shows how developing nations often toggle this tax on and off as a tool to either heat up or cool down their economies.
It really is a lever, isn't it? It's not just revenue collection. It's a throttle for the entire economy.
That is the perfect way to describe it.
So we have covered the mechanics, the psychology, the costs, the loopholes, and the global map. It feels like we have to ask the big question now. So what does this all mean for the future? Where is this all heading?
At the end of the day, it all comes down to a fundamental debate, a tension between fairness and efficiency.
Okay, unpack that for us. Fairness versus efficiency.
On one hand, you have the fairness argument. Capital gains are disproportionately how the wealthy make their money. If you work a 9-to-5 job, you pay income tax on every single dollar you earn. So if you are a billionaire living off stock sales, shouldn't you also pay tax on your gains?
That seems like the standard argument for having a high CGT. It's about progressivity.
It is. It's about taxing wealth, not just labor. But then you have the efficiency argument. As we saw with the locked-in effect in the Legion study, taxing capital gains freezes capital. It stops money from moving from old, unproductive investments to new, innovative ones. It stops people from selling houses. It creates deadweight loss in the economy.
So if you tax it too much, the gears of the economy grind to a halt. But if you tax it too little, wealth concentrates at the top, and the working class feels, rightly, that the system is rigged.
And that is the pendulum swing we see throughout history. A country lowers rates to spur investment. Then a few years later, a different government raises them to address inequality. The U.S. lowers rates in 2003, raises them later. Kenya abolishes it, then brings it back. Every country is constantly trying to find that Goldilocks rate where you get the revenue you need without killing the market.
And that inflation argument really sticks with me. I feel like it's the hidden variable here. If we enter a period of high inflation, capital gains tax becomes so much more punitive.
It does. Dramatically so. If inflation is running at 10% and your asset just keeps pace by going up 10%, you have made zero real money.
Wow.
But the tax man shows up and treats you like you made a 10% profit. That can destroy wealth accumulation for the middle class very, very quickly.
It feels like there is no perfect system. Every single option we've looked at has a downside.
There isn't. It is always, always a trade-off.
Before we wrap up, I want to leave the listener with something to chew on, a final thought. We talked a lot about those professional trader definitions in places like Switzerland and New Zealand.
Yes, that blurry line.
In a world where everyone has a trading app on their phone and algorithms can conduct high-frequency trading for you while you sleep, where is that line now? At what point does managing your own money become a job?
That is a great question. If you use an AI bot to trade crypto for you 24/7, are you the professional trader? Or is the bot? The tax codes were written for a world of paper stock certificates and phone calls to a broker. They are struggling badly to keep up with the speed and nature of modern finance.
And then think about the locked-in effect on a global scale. If that theory is even partially true, how much capital is currently frozen in the world economy? Trillions.
Easily trillions. Just sitting there stagnant in an asset that might not be the best use of that money, all because someone, somewhere, doesn't want to write a check for a 20% tax bill.
Imagine if that capital was released, if it flowed into new businesses, new technologies, new infrastructure.
It's a staggering thought. The tax code is literally shaping the physical world around us by holding that money hostage.
It is the invisible hand, but this time the hand is holding a tax form.
A perfect summary.
Well, on that note, we hope this deep dive has helped you understand why that silent partner in your transactions is there and why they operate the way they do. It's not just a number on a form.
And please remember, check your local laws before you sell that vintage Spider-Man comic. This is not tax advice.
Absolutely. We're not tax advisors, just two curious people with a giant stack of research. Thanks for listening to The Deep Dive. We'll see you next time.
Goodbye, everyone.